Good morning, everybody, or good afternoon, depending on where you are. I'm in Texas, so where it's about noontime our time. Honestly, it's been a great day. It's very pretty outside. There's no rain, but there's hardly any sun, so it looks nice and pretty out there. Today, we are going to be talking a lot about the commercial industry. And the reason we wanted to do this class is we actually have some special commercial events coming up just scheduled for everyone out there. In addition, we've noticed that our clients have taken a drastic shift in where they are investing their money. So remember, as we go through this process, feel free to leverage the chat box. Ask me any questions you have as we go along. We do have a moderator that will be able to answer along the way. Hey, Ronnie, how you doing? Ronnie's a good client of mine. We actually just saw each other for dinner the other day. So I love that. Anyways, so as we go about this, one of the key things is I'm going to talk about the past just for a minute before we start going into our presentation. In pre-2017, or we're going to call it about 2016, most of our clients were single-family real estate investors, buying single-family homes, fix and flips, rentals, subject tos, typical wholesale deal, those type of things. But in 2017, our clients took a drastic shift. And what they started doing was a lot of notes. They started lending money. And as a private lender, they did enjoy this a lot more because it was a lot more passive. I would argue there wasn't as much profit in it, but it took a fraction of the amount of time. Well, what ended up happening right around 2020, though, all right, ignoring the COVID stuff, people wanted another passive style investment. I think they got bored with notes. Well, as they got bored with the notes side of things, what really started to happen is they were trying to find a way to maybe do an investment that wouldn't last 6 months or a year, but would last multiple years and give a higher rate of return. Now, when I say higher rate of return, I'm going to talk about a bare minimum of 12% a year, all right, and above. That's a fancy way of saying 1% a month. Now, that's where these commercial deals really started coming into play. Hey, Kevin, how you been? Investing with your IRA is powerful. I love it. Yes, it is. So, as we get started, please note that everything we're talking about, I get the unfair advantage. I have the ability to see all my clients' investments. All those investments you guys do, whether they're good, bad, indifferent, I get to follow those trends, right? So I really do have that unfair advantage. And lately, we've seen a lot of our clients shift over to the commercial style investments. So we're going to talk about that a little bit and figure out what that is and how to go about it. Now, that being said, we're going to go and just share my screen real quick. Sorry, guys. Bam and bam. So I like to call it passive and profitable while growing our IRA through commercial real estate. As always, we start with our disclaimers. I can't give you tax advice, legal advice, investment advice, nothing like that, especially on this platform. So we're only here to give you guys education. And remember, this education is based off the trends that we see internally. We have about 20,000 clients. So we do get to see this on a very consistent basis and get to follow those trends easily. So I start off always, and I like to talk about how the IRS views everybody. I say the IRS puts us all in the two categories. First one is a taxable category, right? If I do investments, I make profit. If I work a job, I make my money. I have to pay my taxes. But we also have a non-taxable category. Now, what is a non-taxable category? A lot of times we think of churches and charities, nonprofit organizations, but believe it or not, this is a self-directed IRA. So remember, taxable is those things that you personally establish. You work in your job, your LLC, your S Corp, even if you create a trust, all taxable. Non-taxable entities, remember, is a self-directed IRA, a solo 401k, a QRP plan, which Quest can set up any one of these. We can do the same investments on both sides of the fence. One side we pay taxes, and the other we do not. Okay? So what is a self-directed IRA, guys? Remember, self-directed IRAs are just a marketing term. They're made up, right? It's really just based on what the custodian, in this case, Quest, lets you invest in. We let you take your IRA and invest in real estate. Fidelity lets you take your IRA and invest in stocks, bonds, CDs, mutual funds. Don't think that one is better than the other. Find a custodian that lets you invest in what you want to. Now, there's all sorts of benefits. We got our diversification, tax saving, social investing, and investing what you know best. Now, we want to take each one of these and break it down. This is not a basics class, so I'm flying through this portion to give everyone a pretty good, solid foundation. But knowing that, remember, we don't want all our money, all our eggs over there in the public market. Let's take some of those funds and move it to Quest so we can do some of the real estate. Don't forget about the tax savings. That's the biggest aspect, knowing we can do one of these commercial investments and avoid 100% of the taxation on any of the profit. I like the social investing side because it is really unique when you do an investment and you are investing into a new community that could be being built, into this new apartment complex, into a senior living facility, and you actually get to see it grow up and you provided homes for multiple people. Lastly is investing in what you know best. Obviously, if you're joining this webinar, you're here to learn more about investing into real estate. So let's use these self-directed IRAs and let's actually invest in what you know best. Remember, there's 7 types of plans that can be self-directed. Traditional Roth IRAs are the most popular, but you can also set up a SEP or a simple IRA, even solo 401ks, health savings account, and covered L accounts as well. Now, Quest can set up each one of these accounts for $100 minus the 401k. It does cost $1,500, but it's a one-time fee and you're good to go. So if you are out there and you need a new traditional IRA, need a Roth IRA, just need some sort of self-directed account, give us a call. It is literally $100 and we can get it set up in 24 to 48 hours. So it's very, very fast. Okay. So we also teach classes about each one of these. So if you are interested in one of these, just let us know. Right? We try to do classes at least once a month on these topics. Now, what type of plans can be self-directed? Obviously, all the above types. Remember, when you set up a self-directed IRA, that IRA actually becomes its own entity. Because it's its own entity, it will have its own legal name. And I posted one down there below, Quest Trust Company, FBO, John Smith, IRA 12345. That is the person doing the investment. So just remember that. And if you're partnering IRAs, there's specific vesting as well. If you have questions about this, once again, call your IRA specialist. We're here always to help you out. Now, we understand that we have all sorts of investment choices from real estate to promissory notes, but today we're focusing on that middle section, the private entities. So I'm calling this a private entity because most of the time we feel that we're investing into multifamily. But really what you're doing is you're investing into something in the middle, and that middle entity is what's taking your cash and actually doing the real investment. You've always done this. You didn't invest in an iPhone, you invested in Apple. Apple took your money and built an iPhone. Well, in these cases that we're going to be talking about, you didn't invest in something like a multifamily deal, right? You took your money, you invested typically into some sort of LLC. The LLC took your money and then went and invested in the multifamily project. So keep that in mind. If you guys are doing these investments, you want to work with our private entity department, okay? Now, we're going to slow it down. That was what I like to label as a basics class. So we're going to kind of change gears a little bit. We're going to talk about some of the first problems we see, and then we'll get to some real case studies, okay? So problem number 1 is something that we like to call disqualified people. Now, that is a legal term used by the IRS. What this means, I cannot take my self-directed retirement account and invest into my own project, right? The IRS says, hey, look, there are certain people disqualified from your IRA to do specific investments. So I'm number 1. I can't take my IRA and invest in me. Does not work. I can't take my IRA and invest in my LLC. Doesn't work, y'all. But you're smart. So you always come up with some unique ideas. And people go, oh, well, I'll set up an additional LLC or a series LLC or I'll invest in my wife, not me. Guys, the IRS is not that dumb. They gave us this ugly looking list here on the screen, and it breaks down real easy. My retirement account can't invest in me, my spouse, my parents, grandparents, my kids, my grandkids, their spouses, and here's the kicker, even their companies. So just setting up an LLC, setting up a trust, setting up a new business does not hide it from the IRS. So please remember that, because this is the first problem. Now, normally when I present problems out there to individuals, I do my best to find you a solution. So guess what the solution is? There isn't one. There is no way around this. And the reason why, because if the IRS catches you, you could lose your entire retirement account. Think about that for a minute. Most of you out there have a retirement account you've been saving up for 5, 10, 15, 20 years. So why would you risk it? Because if the IRS audited you, they could take it away, all because you were trying to hide a transaction and take your retirement account money, invest in you. It does not work. And unfortunately, a lot of you out there do it anyways. And eventually what will happen is the IRS will audit you and you'll lose it all. So if you're out there and you're listening to this and you're one of those people, please be very careful. And I highly, highly, highly recommend you considering talking to a tax attorney or CPA. All righty. So now that we've done it, let's actually talk about why everyone came here today. We all wanted to talk about the commercial properties, how the market has shifted, and why people have changed from buying single-family homes, doing notes, to the commercial side. And this all comes down to one thing: raising capital. So we're going to focus on that section first. So let's talk about some of the raising capital aspects. All right. First up, raising capital. The proper term or legal term you'll hear in this is called a syndication. So if any of you out there are investing into someone that is raising money, you're investing into their syndication. That is what the SEC calls it. That is what the IRS calls it. So who raises capital right now? Well, the most common way is to understand for IRAs to invest. It's very passive, right? The time frame for any one of these investments will be 5 to 7 years, and you must do your due diligence. So why is it so common for an IRA to do one of these investments? Remember out there, you have a retirement account, and you've probably always put it on the back burner. You don't check it every day like you check your savings account, check your checking account or a brokerage account. Because of that, if we invest in one of these syndications, one of these people raising capital, your average investment will last 5 to 7 years. Well, that's good to know, because I'm not taking money from my personal account, draining it to do one of these investments. I'm taking money from an account that I'm not planning on living off of today. So we love to see the IRAs do this. And I think this is why there's such a big, big shift. Remember, this is also passive. You can do something once today, and for the next 5 to 7 years, your retirement account is fully vested and invested into one of these commercial style properties. The downside, you have to do due diligence. There is a lot of good sales people out there and will sell you on why their investment is the best. And what they do is they overpromise and severely underdeliver. Now, Quest is going to help with some of these, and I'll show you how at the end of this presentation. So remember each one of these. We're going to kind of tackle each one of these as well. Now, remember, very beginning of the slide, I said, so who's the one raising capital, right? Who does it? Well, the most common one right now seems to be multifamily. Multifamily is a form of commercial properties, right? It's where you're investing into their syndication. Now, either A, they're taking a Class C, is what they call it. This is one of those lower rundown type of apartments, and they'll build it up to a Class B or even a Class A, right? Where it's much nicer, a little bit more expensive. You know, and think of it like doing a rehab. So what they do in a multifamily section is they're going to rehab this property, make it look nice and neat, and then they're going to bring in a new property manager and get it all rented out. Now, that process takes time. Now, in addition to that, they're also typically, you will see on multifamily side, they might buy a big chunk of land and they build it all the way up, right? We start from the ground up. You can do this as well, but make sure we're doing due diligence on each one of these individuals and make sure you know the area. Hotels. Hotels have popped up all over the place as well. Now, they're not as popular because of Airbnbs and VRBOs. So if hotels aren't as popular, what do we mean by hotels? A lot of times, these are going to be the smaller beach hotels. You're not investing into a Hilton being built, right? That's not the case. You're talking about one of those beach hotels you always see that kind of makes like a half U, and they go that way, and they're really, really small, no more than 20 to 30 rooms. These are very popular where people will invest in them, and then they're individually rented out. Self-storage units. There's a group out there by the name of Spartan Investments. They do a lot of these out there. They have some great free education if you want to learn how to do self-storage. But it's unique that no matter what, Americans like their junk. We really do. Right? Think of, you got Prime Week coming up. Literally, is it like this week or next week? I know my wife's looking at it because she's already putting stuff in a wish list to buy things. Well, knowing that, we like our junk. So self-storage seems to always be there. And it's one of those almost seems to be very recession-proof. Senior living facilities. With the baby boomers, as they've gotten older, what's unique is these baby boomers out there, they are now getting to the age where they could have things like dementia. They might not be able to take care of themselves. Well, you have this huge shift of these people getting older. They need a place to stay. So a lot of people are investing into senior living facilities. And lastly, most oil and gas investments. This could be you investing in mineral rights, right? Or just investing in maybe the drilling aspect of the oil and gas itself. So each one of these guys is a form of commercial real estate investing and is all done through syndications. Someone raising capital, and then boom, you're doing that investment. So remember that. No matter what, you're still working with the private entities department. You're investing your IRA into an LLC. The LLC is going out and doing one of these investments. Keep that in mind. So let's talk about some more problems. See if you can't find any solutions. It could be a form of fraud. Remember, this is the hardest aspect for people to really do due diligence on. So you must do due diligence. Background checks. Well, Derek, I don't know how to do a background check. Honestly, one of the best things to do, check their social media. We used to work with a guy a long time ago, and he ran like this note program. Well, all you got to do is Google his name, bloop, and he pops up now in a jail cell, like in an orange jumpsuit. It's funny, but like, guess what, guys? You can easily do due diligence like this just by taking the individual's name and putting it in Facebook, putting it in Instagram, putting it on YouTube, putting it on Google, and you can find so much information out about them. Most of the time, you're not even looking at the company because the LLC or the company that they created you're investing into is brand new. There's no information about it. So you got to check out for the information on them, on the individual you're working with, and their board members or their other, what they call general partners. So do this for each individual. You can also just put their name in Google and put fraud or SEC violation afterward. And it's surprising how many times things will either pop up. And if nothing pops up, that's usually a good sign. Next, you want to understand the investment. What do I mean by understanding the investment? Well, a lot of times we're investing into some of these projects, and I'm guilty of this, where I invested in something all because I liked the team. I liked the individuals I was working with. But ask me what I really invested in. Oh, no clue. All right. You need to, if you understand the investment, you'll understand the timeline. I want to know if I'm investing my money. I don't want it to be sitting there for 1 day, for 1 month, for 1 week, for 1 year, for 10 years without me knowing what it's doing. If you tell me up front, hey, Derek, we're going to take your money, you're not getting it back for 5 years. I appreciate that. You know why? I now know what to expect. Make sure you stay in contact with me, but I want to know what's going on. Understand what happens if the investment goes wrong. When investments go bad, this is usually where things start to change shape. A lot of times as things go wrong, we don't know what to do. And one of these things, a lot of times in syndications, is we'll say, hey, you invested $100,000. That was every penny you had. But unfortunately, we ran into some hiccups. Because a deal goes bad, doesn't mean the person's bad. Things happen, right? Think of COVID. Think of the freeze if you're out here in Houston or Hurricane Harvey. So a lot of times we'll see things where a syndication they do an investment, and a year or two later, they need an extra $10,000, $20,000, $50,000 from every single investor. And you didn't read the fine print where you need to put that money in. You invested every dollar you had. What do you do? So understand what happens if things don't go according to plan. Okay? Next problem is something called plan asset regulations. Ask the syndicator if they've heard of this. If they go, nope, never heard of it, I don't know what that is, that's a problem, okay? In most cases, plan asset regulations will only apply really to retirement accounts, okay? So I'm just going to talk about it. I'm going to put up a couple things here on the screen, but I like to talk about it from a prohibited transaction standpoint. So first off, my retirement account, according to the IRS, can't invest into myself, my spouse, my parents, my kids. We defined that earlier. The reason why is the IRS says those people are a fiduciary to the retirement account. So remember, I'm a fiduciary to my retirement account, my spouse is. Now, if you're someone raising capital, I don't know you, we're not related. So indirectly, you're not a fiduciary. However, if you are only raising capital from retirement accounts, the IRS says, hey, guess what? You are now going to become a fiduciary, and potentially everyone just entered into a prohibited transaction and you didn't even know it. You weren't purposely trying to do something wrong, but the person who invested in didn't understand these rules and regulations. So most of the time when people are raising capital, they will only allow 25% of the money they raise to come from retirement accounts. Why? Because that keeps them below that threshold. They don't become the fiduciary, and they're well aware of this fact. Can you imagine someone, instead they raised 30% of the capital from retirement accounts, they didn't know, and all those people that invested lost their retirement account and they didn't even know what went wrong. So make sure your person you're working with understands what a plan asset regulation is. Most of the time, it's funny, the syndicator will not. The person who actually invests in, they don't understand the legal jargon. But you know who does? The attorney. The attorney that drafted up the operating and subscription agreement that you are reading and looking into. So make sure that you can just do Control F on your keyboard and you can search through that whole document and look for things that, and it will say this. There's usually a section right in there that talks all about this. Which also, that same section talks about things such as UBIT and UDFI. So we're going to talk about UBIT and UDFI here in just a minute as well. If you're going to raise money, guys, the only thing I can say is don't be cheap with the attorney. That's it. Use a competent, a good, solid, someone who's smart, and quit being cheap out there. Oh, you didn't want to spend the extra $2,000 on an attorney and use LegalZoom. Swear to God, I see this all the time. People use LegalZoom to set up an LLC to raise capital. They don't even know the SEC rules, and people start investing in them because the person's a good salesman. God, that's so scary. It really, really is. It doesn't work that way. You actually have to file certain forms with the SEC and go through those motions properly. You really do. So, can an IRA investment be taxable? Remember, I said that when we use an IRA is completely tax-free, which it can be, but there's times that investments become taxable. And that's something called unrelated business income. Now, the IRS gives us 3 times this happens. 2 of them you see here on the screen when my IRA is owning a business. As an example, if my IRA tried to set up a coffee shop, well, if I didn't have to pay taxes on that income, I could sell it a lot cheaper. So this means that if I'm selling stuff cheaper than Starbucks, I could actually put them out of business. So they tax me unrelated business income. Now, the other thing is owning personal property. I actually, about once or twice a year, I get calls from cops that are recently retired. And it's always funny. It's the same conversation. I got this cop. He says, dude, I got this great idea. I'm going to use my IRA and buy cars at the police auction because I can get into it. I can buy them dirt cheap. I'll pay someone to drive the car to the mechanic. I'll pay the mechanic. I'll never touch the vehicle, and then I'll just sell it. Well, the IRS says that is not personal property. So because of that, they label it under a renting of a personal property style type thing, and you actually get hit with this as well. Now, all those you don't care about. When you're raising capital, an IRA can be hit with something called UDFI, or unrelated debt finance income tax. Every multifamily deal I see, every storage unit I see, every senior living facility I see, this is what happens behind the scenes. All right? Every single one of them. Someone's raising capital. Let's say they need $10 million. They raise $3 million. They borrow $7 million from the bank. Well, in these cases, your IRA technically took a loan from the bank. Oh no. What does that mean? It means you have to pay taxes to the percentage of debt leverage on the profit. So if I'm 70% debt leverage, 70% of my profit becomes taxable. So if my IRA is going to be taxed, is there a way I can get through it? Absolutely. Now, what you want to typically do, right, is understand first who pays it. The IRA guys. Your IRA is going to pay the tax, not you. So keep this in mind, because if the IRA is paying those taxes, you don't want to be paying them from your own personal pocket. If you're paying them from your own pocket, the IRS looks at it as an over-contribution, and you get penalized on the amount that you paid. Okay. So if an investment is taxable, why are we using the IRA? Well, where's your money? Remember, most of us have more capital sitting in the retirement account than our old checking or savings. What is the rate of return? Most of the time, if you did this investment personally, 100% of the profit is taxable. Remember, doing it in the IRA, potentially only 70% of the profit is taxable. And believe it or not, we can get rid of most of that. So what will the taxes be, if any? It's something called a depreciation, investing in taxable entities and loan don't own, or we can use a 401k. So remember, when we're doing one of these investments, at the end of the year, the syndicator will give us a K1, a profit loss statement. When they give us this K1, it shows us how much money we actually lost in the upper right-hand corner under Section 3. Well, they already pre-calculated your depreciation. Knowing this, what's unique about that, as they talk about it, you actually get to claim all your deductions when you finally make your profit on the back end. So year 1, year 2, year 3, you usually will have enough deductions to offset most of the UBIT. Remember, I said about 70% of it's taxable. Well, if you have 60% of that can be deducted, only 10% of your profit's taxable. It ends up becoming such a small amount, if any at all. We can always invest into taxable entities like a C corporation. This is not as common, but I do see it done. Usually when I see someone investing into a hotel where they are building the entire thing, I'm talking, it's not a $100,000 or even $1 million deal. We have a couple of guys that do this where they invest $8, $10, $12 million at one time, one sitting. They just go bloop. So that's usually where you see something like that. You can loan, don't own, meaning just be a lender in some of these. Some of the syndicators, what's nice is they actually allow you to be a lender, and you can lend them money versus taking part in the syndication. And the lastly is setting up a solo 401k. Quest can set you up a solo 401k in 48 hours or less. And this whole thing we're talking about with UBIT and UDFI, solo 401ks are exempt when it comes to these type of syndicated investments. All these commercial deals, the 401k has an exemption already pre-built into it. So why don't you have one? You probably don't qualify. You do have to qualify for a 401k, meaning self-employed, pay yourself from your company, no common law employees, and at the end of the year, the company has to show a form of profit. Most of us won't qualify for that, but if you do, 401ks are very powerful in these examples. So remember, we can always use depreciation to offset any of the UBIT and UDFI. This is the biggest thing out there when we're using the IRAs for any one of our commercial investments. Okay? We can always use a taxable entity like a C Corp. We can always be on the lender side, and we can always set up a solo 401k if you actually qualify. Right now, 401ks are becoming more and more popular. Once again, more and more people are doing commercial investing. So if you're out there and you're looking at it, make sure you understand how to legitimize the account, and we can teach you that. We're even right now building out an entire software that will do the bookkeeping, the record keeping, and even prepare the tax forms for you. So that way you don't have to go through it. And you get checkbook control, which is really cool. I mean, you just have a checkbook in your hand. So we allow for all that stuff. Give us a call or set up a consultation if you're more curious about setting up one of these solo 401ks to see if you qualify. Okay? Now, key takeaways from over all this is make sure you get started on some of these past investments. The biggest one, do your due diligence. Use your IRA or 401k. And how do we find your next deal? So that's where I really wanted to spend a little bit of time here and talk about where can we find your next investment. Now, when we're talking about trying to find that next investment, if you're considering commercial properties, what is the best type of commercial property to be looking for? God, I don't know. Some people like the storage units. Some people really prefer the multifamily. Some people prefer the senior living facilities. So what we're doing, if you are actually in in Dallas, we are going to be doing a humongous elite multifamily summit in Dallas on August 12th. If you would like to go to this, tickets are cheap, guys. They're like $75. It really is. We're bringing in multiple different investors on here. And what I'll do is I'll put this link right down there in the chat box. Or Andre, if you're still on, if you could put that link in the chat box, would be awesome too. I think it's that one right there. Let's see. Yeah. So we'll put that link right there in the chat box just for you guys, but you want to be coming to this event. Why? I can sit here and talk till I'm blue in the face about these syndicated investments, about these commercial deals. However, we're bringing in, I want to say 10, it might be 15 different syndicators that are not selling you on investments. They're there to answer your questions and help you figure out which commercial deal is best for you. Think about that. You're going to have attorneys and CPAs that can answer those tax and legal questions that you want. We're literally going to be having a full Q&A over this entire day of specialized individuals that can help answer everything that you need if you want to invest commercially. This is huge. Now, I said this is in Dallas. If you're out there and you're in Houston, I got one better. This is next week. And we're calling it a luau, but what we're doing is we are hosting a humongous networking event where we're expecting about 200 to 220 people there, and we are pairing you up. Are you a syndicator? Are you raising capital? Great. I can pair you with someone that has money to invest. Are you on the other side? Are you the investor? You have cash, you don't know where to put it? We can pair you guys up. That's what this event is for. Guess what? This event is 100% free to everyone that is listening and watching on this StreamYard event. This luau that we're going to be doing, I will buy everyone out there that shows up their first drink. Why? It's open bar. So drinks are on me. I would love to get you guys out there a beer, get you guys some wine. Right? We're going to be doing a Korean barbecue. We're going to be putting a lot of stuff together. And I'd love to see you guys sign up. So remember, this event is 100% free to you, and we're pairing everyone out there together. So that is, I think, one of the biggest things out there is a lot of times we don't get to see people join us at these events. So remember, guys, join us for one of those luaus. Let me know if you have questions. We're going to keep this chat box open because I think a lot of times people send us messages or have questions about some of these. So I'm going to keep these open right now. Oh, I got a message from Kevin. Hey, I'll be at the Austin and Dallas one. Good vibe. Right on. I love it. Too bad you're not out in Houston. So we are doing that luau in Austin and Dallas as well. I only mentioned the Houston one because I'm in Houston, so I'm excited for it. But all three of them in Austin, Dallas, and Houston will be hosted on July 11th. Thank you, Kevin. Appreciate it. Remember, the key thing before you do any of these commercial investments is due diligence. So please feel free to ask me questions while we keep this open and alive. But God, I can't talk enough about the due diligence. We see more of these investments go good and bad. The hardest aspect to them, I see some of the things popping up right there for Facebook. That one is for the luau, I do believe, out there in Houston. So make sure you sign up for it, guys. But unfortunately, when we see people do these commercial investments, I'm not exaggerating when I say people double their money. You invest 100 grand, you make 100 grand in profit. Because of that, it's very enticing, and we see people don't do enough due diligence. Since they don't do enough due diligence, they don't know who they're investing in. They don't understand what they're investing in. And since they don't understand it, we see a lot of them lose their capital. And it all comes down to Slick Sam that came in and convinced you to invest with him. So come to the luau. Come to the Multifamily Summit. let us teach you how to do the due diligence property on these commercial properties. You can't do it in an online setting. It is physically impossible. You need to be there in person. If you really want to know how to invest your money properly, you got to get off the couch. So overall, guys, that's all we have for today. If there is any other questions that pop up, I just got one from Jim. Let's see. I believe you mentioned that depreciation and expenses can be applied on the back end. This could be 10, 15 years out. So is there anything that needs to be done in the meantime? Absolutely. Great question, Jim. So what he's talking about is when my IRA does an investment, right, in a syndication, what you need to do is be saving your K1s. Now, depending on who you talk to as a CPA and what you expect, a lot of people would argue you need to file a 990T each year. Now, it doesn't mean you owe any taxes, but the 990T will help calculate and save the depreciation and stuff that you have throughout the years. Now, in most cases, any syndication, you don't make any profit until the back end. I did not say you didn't receive a good faith payment. We do sometimes get payments on a monthly or quarterly basis, but you don't actually make any profit until you receive your initial amount of capital back. Because of this, the IRA can actually backdate and claim all the losses previous years prior. You, as an individual, don't typically do this. You usually claim your losses in the year they occur because you have other investments outside that you can use to offset it. Could just be your own W-2 income, right? The IRA, though, cannot receive a tax return like you can. Because of that, the IRA actually gets to save up all the deductions throughout the years and then claim it all in one big chunk. So make sure, a lot of CPAs will tell you to file that 990T and save your K1s the syndicator gave you. So I hope that helps, Jim. Great question. I'm going to post your question up there one more time. Love that. So don't forget, guys, we're going to be going over that section Jim just asked in detail at the Luau and at our multifamily summit that we have coming up in Dallas, and the Luau coming out in Houston, Austin, and Dallas, both on July 11th. Thanks, Ronnie. Appreciate it. Ronnie's a good client of mine. If you ever see him at the events, he brings his kid with him. He has his kid learning how to invest in his early 20s. Dude, his kid's going to be a millionaire before the age of 30. It's incredible if he's not already a millionaire. So, smart guy. Anything else, guys, before I close out the live? I want to make sure I get to everyone's questions. I'm going to keep this open for about 10, 15 more seconds. I'll sing to you. I'll do a dance. We'll do the luau. I love it. Sign up for those luau's, guys. One more time with that link on the screen. Going once. Going twice. All right, everyone. Thank you so much for joining us here on our Self-Directed Saturday. We love to have you all here. And don't forget, if you have questions, reach out to your IRA specialist. You can do so at any point in time. Oh, is there a checklist for due diligence? Yes, there is. I can't give it to you here in this setting, but if you want to email me or come to one of our events, we can do that there in person. It's a lot easier. I'll put our email down here in the chat box. Hold on, I'm going to put it and have that posted. Good question. Bloop. Bam, that's my email. I just put it up there. So take it down, send me an email, and I can get you a checklist. Or if you show up in person, we can actually dive down in person at one of our events, go through the checklist individually and what you're really, really looking for, okay? Remember, Quest, we don't give tax, legal, or investment advice. All we do is give education. So in these type of things, I try to give you what I can. In person's always, always easier. That's why we push things like the summits and the luau's. It's a great question. Leave that email up there for one more second. Boop, boop. Bueller going once and twice. Any other last minute questions? Thank you again, everybody. I do appreciate it. I hope to see you guys in our next meeting, and I'll talk to you soon. Bye, everybody.